Okay, so this is International Finance. I am Andy Kim, your Dr. Finance. We'll finish chapter 11 of Eun, Resnick, and Chulun. And a euro currency market. I told you about the historical background of how this euro currency market flourished, and especially in London with the influence of this German Jewish banker called the Warburg family, right? And then euro currency market, well, this is more about the wholesale level idea, 도매금융. 도매 means like wholesale, like bank to bank relations, not bank to customers, retail customers like myself or you and me. No, it's about bank to bank. It's a playing with the big boys now, right? So big boys, right? Or big girls, whatever, right? Doesn't matter. The short-term interbank borrowing and lending among these big banks is the issue. Overnight lending and borrowing. I told you before, in bank balance sheet, right? Assets and liabilities and equities. It's all about asset liability management, as I said before, right? Sometimes you get extra cash. Sometimes you need some more cash, right? As you balance out day by day in your banking business, right? So overnight borrowing and lending has to happen, right, as a quick money, and especially in terms of US dollars, because this is the reserve currency of the whole country, of the world. And then there were a lot of excess US dollars naturally after the Second World War. So the most euro currency transactions are interbank transactions in the amount of $1 million and more. Okay. Common reference rates in borrowing and lending, right? In Korean interbank lending right? It will be like what? Call 금리 or something, call rate or something. But in US, what is that? Eurodollar market, short-term borrowing and lending rate, the benchmark rate is called LIBOR, okay? London Interbank Offer Rate. And if you go to, Paris, other financial centers of the world, they have their own IBORs, right? IBOR, interbank offer rate. So interbank, bank to bank, offer rate, okay? Paris, PIBOR. Singapore, SIBOR. Hong Kong, HIBOR. Tokyo, TIBOR. Korea, KORIBOR. Yeah, so that's that. Among these, I would highlight SIBOR and LIBOR, right? Not because I simply lived in Singapore for 5.5 years, but this is a very important rate in Asian transactions. And then if you look at capital market in Asia, right? Singapore is very big in terms of fixed income trading and FX trading, okay? Rather more formalized banking business, right? 점잖은, like more for the standardized products over there, and derivatives kind of things. Hong Kong is big in terms of more aggressive businesses like IPOs or M&As or like takeover, like that, right? IPO. So in that sense, right, SIBOR is an important rate in Asian FX fixed income trading businesses. And then a new reference rate for the new euro currency is occurring, and Euribor is there. The rate at which interbank time deposits of the euro are offered by one prime bank to another. Now, moving down, forward rate agreement would be there, okay? Why forward rate do we have to worry about? Because this is about interbank lending and borrowing, and then the asset liability management, and then these asset value and liability values, right? Depending on the interest rate movement in the euro dollar market, your asset value and liability value may mismatch, right? You don't want that mismatch happening. So how would you take care of this risk management, right? In ALM, let's get into forward rate agreements. That's what they said. That's what they do. I told you before about it in the last class. Forward rate agreements can be used to the forward rate, by the way, previously in the chapter 6 or something, 5 or 6, we studied about the forward FX rate, FX forward. Here it's about interest rate forward, okay? So it's different. And then hedge assets that a bank currently owns against the interest rate risk. So for example, a bank that has made a 3-month Eurodollar loan against an offsetting 6-month Eurodollar deposit could protect itself by selling a 3 against the 6 FRA. I'm just going through those set of slides that we covered in the previous class, next 4 slides or something. So if you're through with it, you are mastered with it, you can skip through, okay? Anyway, speculate on the future course of interest rates. Now, forward rate agreements, here's an example. Again, right, a 3 against 9 FRA is a 3-month forward contract in a 6-month interest rate for a 6-month period beginning 3 months from now, okay? So what's that? The agreement period is from now to 3 months from now, and then cash settlement happens for FRA, and then the FRA period is 6 months secured, okay? Now, at the end of the agreement period, the loser pays the winner an amount equal to the present value of the difference between the settlement rate SR and the agreement rate AR, sized according to the length of the agreement period at the notional amount. So notional amount is like a principal kind of things, right? And then here's the ugly formula that you see. In the end, what you see is a present value formula because you are dividing the ugly term in the numerator, the big thing in the numerator, divided by 1 plus interest rate. That is present value, okay? Present value over the period of this FRA period, okay? And then that's a present value as standing at this cash settlement date over here. You see that? Arrow, yeah. And then notional amount times the difference in interest rate, settlement rate minus agreement rate, and then the periodic figure over here, okay? So settling on FRA, right? Forward rate agreement looks like this. A 5 million euro, 4%, 3 against 9 FRA. Let's assume it. And we entered into January 1st of 2018. Actually, in the previous lecture, there was a typo over in this equivalent slide, right? 3 against the 9 FRA. So January 1st, it has to go until the full month of September, right? 9 months, right? And then at the end of 3 months, it should be April 1st, which is the payment date, okay? Settlement day over here. In the previous slide, it was like March something, okay? But it has to be April. Now, so the rest of the numbers are the same, right? The 184 days, because this is 6 months, right? 6 times 3, 180, and then plus 4 days over there. And then 360 days convention in the bond market, right? On April 1st of 2018, if the actual rate is 4%, then there is no payment, right? Why? If you see this formula over here, SR minus AR, agreement rate is 4%, and SR, what is that? The what is it? The agreement rate, right? The agreement rate and being, wait a minute, yes, agreement rate being 4%, and then the settlement rate, which is the actual rate, okay, which actual rate being 4%, makes this one 0, okay? Yeah, this one 4%, that one 4%. So all in all, this becomes 0. And the numerator being 0, everything is 0. So that's why, okay? Now, if, on the other hand, if on April 1st, the settlement rate or actual rate is 5%, right? Then the seller pays the buyer 24,918.74 euros. If you do this math, then you will realize that this is the number, right? stop it for a second, and then you do the numbers and check it. Now, if on the other hand, on April 1st, the settlement rate is only 3%, the buyer pays the seller, right? This time the buyer pays the seller as much as 25,169.62 euros, right? And that's, if you do this number with the 0.03, okay, 0.03, and then if you do the numbers, and then you will find out this is the answer. So that's that here. And then the proof of FRA utility as a hedge, right? You will see that whether the settlement rate is higher than or lower than 4%, you will get the same numbers over here. FRAs are designed so the buyer will have the same future value of interest expenses. Same interest expense, i.e. perfect hedge at the agreed up rate for any value of LIBOR at the maturity of the FRA. So calculate the future value of interest expense. If LIBOR at expiration is 3%, then it should be 5,102,222.22 euros, right? Why is that the case? Well, if you see this, right, it's going to be the notional amount. Once you do this ugly math, you will realize, right, notional amount plus notional amount times AR minus SR times the period over 360 days, and then calculate its present value, and then from then on you compute the interest and principal added to it over the FRA period, like that 6 months period, right? Then if you do that math, then you will realize, let me pull out this one, okay? These two are identical, right? I told you before, it was getting this part was getting a present value, okay? Getting a present value, but this one is rolling it back, getting the interest amount using the same discount rate. So it should cancel each other out. But this one is remaining over here, so that you have to multiply this guy by notional amount. So that's this guy. Okay, that's this guy. So once again, this guy times this guy should be this guy times this guy. See that, right? And then what you see over here is just this ugly term over here times this guy. There, the denominator gets cancelled because of this guy. So you have notional amount times this one, right? That's AR minus SR times days. And this notional amount, well, you gather and together like terms. Notional amount taken out, and that's how it works. And then if you do the arithmetic, you will realize this one, you have a common thing, which is SR times days over 360. SR times days over 360. Here you have minus, there you have plus. So they cancel each other out. What is left is AR times days over 360, and that's what you precisely see over here, and 1 plus a notional amount from the left-hand side of your equation. So that's what's going on, okay? Now, that's if you throw in this notional amount of 5 million, right? And then 5 million times 1 plus the agreed rate, okay, agreed upon rate times the period, days over 360, right? Plus 1. Then that's your right hand side. What you see on your left hand side is this whole ugly term over here, okay? And then 5 million plus something is what you see over here, the notional amount times this AR minus SR, okay, differential. And then if you, right, see $5.1 million over here, million euros over here. And if that's when LIBOR at expiration is 3%. Okay, LIBOR is 3%, 5.1 million. When LIBOR is 5% instead of 3%, what do you get? That's identical. See, it is 5.1 million euro, right? Why is that the case? Because here you throw in 5% in this left-hand side of your equation, but all in all, it cancels each other out so that in the end, it's going to be the same as your agreed upon rate calculated like this, right? And then the same thing, okay? And then all in all, the forward rate agreement, okay? Forward rate agreement gives you a protection against interest rate movement. No matter whether it is 5% or 3%, you see identical amount, right, on your interest expenses, right? And together with the principal, notional principal. So 3% or 5%, it doesn't matter. It's protected at 4% rate. That's the purpose of having forward rate agreement, okay? Now, Euronotes is also there, right? Euronotes are short-term notes. That's a bond kind of thing. It's underwritten by a group of international investment banks or international commercial banks. They are sold at a discount from face value and pay back the full face value at maturity. Maturity is typically 3 to 6 months. And then Euro commercial papers are also there. CP, right? 약속 in Korean terminology. In unsecured short-term promissory notes issued by corporations and banks, that Euro commercial paper, 30 days or something, CD kind of things, and then it is placed directly with the public through a dealer. Right? Commercial paper is a short-term borrowing, 30 days borrowing or something. Not everybody can do. If I try to issue commercial paper myself, nobody will buy it because nobody knows me. Okay, but if let's say Tesla issues commercial paper, everybody will be like, yeah, I will invest in that, so that it's IOU in 30 days or something like that. CD, right? Certificate of deposit kind of things. Commercial paper, CP. Okay, almost the same thing. Maturities typically range from 1 month to 6 months. Right, and then commercial paper, while typically US dollar denominated, it is often lower quality than US commercial paper. As a result, yields are higher. Eurodollar interest rate futures contracts are also there. It is widely used futures contract for hedging short-term US dollar interest rate risk. The underlying asset is a hypothetical $1 million 90-day Eurodollar deposit, right? Eurodollar, right? The contract is cash settled and traded on the CME and the Singaporean International Monetary Exchange. And then the contract trades in March, June, September, and December cycle. Exhibit shows that CME Group Eurodollar futures contract quotations on different dates like that. Settlement and then change and open interest in volumes are shown. And then the next set of slides, I'm going to talk about the LIBOR kind of setting, what that is, right? And so thanks for watching until now, and see you. Bye-bye.